So we're going to talk about what is a properly structured IUL. Um, so the difference between, for some of y'all, some of you know this, some don't, some of y'all that are new. I mean, life insurance is life insurance. Most people think, but you have different types. You have term, you have whole life, you have index universal life. Whole life, there are different ways to kind of structure it. That's another whole nother animal. It's called paid up, additional premium or whatever. But the IUL is what we focus on, really, because it's I think, a superior product to all the others. Yes, if somebody needs term, you need to help them with term. If somebody needs final expense, you need to help them with final expense. That's what our license is for. But when it comes to an IUL, it's not so mysterious, as Neal put it, as people will make it sound scary. Okay. But you do need to know what you're doing, because you can really um, put a person in a bad spot, in a sense. And I'm going to go over what I mean by that. But to make it simple, what is a properly structured IUL? Well, it's an IUL that is structured for the needs of the client. If you always have your client in mind, you're going to do wonderful. They're going to be very happy. You're going to be very happy. It's going to stay on the books. You don't have to, your persistency is going to be way up, and that's what you want. Who wants a charge back? That's a pain in the butt. Okay. Well, how do we do this with an IUL? Well, it's adjusting the death benefit. And when I'm doing my Zoom with clients, I say, hey, as we go to the right, there's going to be more life insurance, less cash growth. As we go back to the left, there's going to be more cash growth, less life insurance. Okay. Well, what is their need? Are they young? Do they have any kids? Are they married? Do they have a mortgage? How old are their kids? Just, you have to ask those questions. Do they have any existing life insurance? If they do, well, you can take that into consideration. If they have life insurance, well, you can definitely reduce the amount of life insurance. If they have no life insurance and they have a $500,000 mortgage and they have a 4-year-old and a 3-year-old, man, they have a lot of need for life insurance. So they may want, all this cash growth, but they also need some life insurance. So again, it's going to fall back to, what are the needs of the client? And then I'm going to show you, there's this thing called option A and option B. Does anybody know what option A or option B is? And if you do, let's just put it in the chat. Don't just everybody chime in. Put in the chat what option A is, and put in the chat what option B is. If you don't know it, just don't even put it in the chat, because I'm going to tell you what it is. And let's see. Somebody can monitor the chat and see what we see how many what we have here. Let's see. Level or increasing, level or increasing. Yeah, but what is A? A is level. Robert got it. 2 points for Robert. B is increasing. So it's level or increasing. So everybody's got it right. Okay. You can and we're going to go over that, what that is. But it doesn't matter if you use a Mutual of Omaha, National Life Group, F&G, Americo, Ameritas, who else do we write? North American. It doesn't matter who you're writing the IUL with. They all use the option A and option B. Okay, that's standard across all IULs, at least that I've seen. Maybe somebody's come up with something else, but for the most part, it's A and B. A is going to be level. B is going to start lower, and it's going to go up. It's increasing. Okay. So anybody got any questions up to this point? You can unmute and say, hey. If not, I'm going to go into the illustration. So I'm using National Life Group. Why? Because I write them more than anybody. Also because I think it has the it's going to make me do a double authentication here. I think it has the easiest illustration. I didn't. Nice. So, and it gives us a lot of information. So I was working with I think Steven on an F&G the other day, and we couldn't find that maximum. I'm just Tennessee, that maximum amount that somebody can fund in 1 year. Okay, and that's sometimes that's huge when people want to overfund these. Okay, so I'm just going to leave everything defaulted here. This is all basics. You guys should know how to ask somebody if they're a smoker or a non-smoker. Okay. So we're not going to get into this kind of small minutia. So I'm just going to come over to the design. So every product, every carrier has a way of designing their IUL. America used to not, and now they now have an option A and B. They used to never have an option A and B because it wasn't really a real IUL. It was permanent life insurance. But that's neither here nor there. So when it comes to National Life Group, I normally will start right here. Minimum death benefit, maximum cash value. Okay. What this does right here is it allows the lowest amount of life insurance to be in there, giving the most cash growth, okay, based on how much somebody's wanting to put into the policy. Okay. So normally I'll start here. Now, there's different ways of reducing the amount of life insurance to give the most cash growth. So just think about it again. Let's just keep it real simple. Let's say this is a 45-year-old, has a $500,000 mortgage, and the guy makes $150,000 a year and has $1 million of life insurance. Okay. Well, rule of thumb of life insurance is you should probably have about 10 times your annual salary. Okay. Because that way all the kids can get through, on their own. By the time if something happens to them, it'll at least pay 10 years worth of his income. Okay. Or her income or whoever's income. So let's just say, since this is a 45-year-old male right here that we're doing this with, that's the scenario. Okay. So I'm going to work on giving the most cash growth in this sense, because this amount of life insurance with his $1 million is probably going to get him pretty close to that 1.5, not quite there, but still is going to give him more than the million he has. Does that make sense? So we'll start here. Minimum death, max cash value. And all carriers, Mutual of Omaha, F&G, they all have some type of min-max. It might be called something different, but it's going to be, maximum cash growth or maximum accumulation, or, there's going to be a name. So they all have like these little toggle things. If not, you can always do none and kind of create it yourself. But this right here is set up for us to make it so easy that you just click it, you click it, and then you now have to deal with level or increasing. Okay, so this is option A, and then option B is increasing. So you have level and increasing. And I'm going to show you these once I'm going to leave it at level, but I'm going to show it once we do the illustration to show you so you can see the effect. We'll put this guy at monthly, and we're going to go right here to specify amount, and he wants to put 1,500 in. So we're going to leave it at 1,500 a month. I always like to have a stopping point. So I use age 67 as a default retirement age, because that's when most people in their 40s and 50s can draw full Social Security. If they're in their 30s and 20s, it's already 72 before they can draw full Social Security. Okay, and not just a partial Social Security. So it'll be 75 here soon before you know it, probably. So that's my stopping point. Okay, 67. Now, let's go to the quick view so we can start and show you where we are with everything. Well, he's got $1 million of life insurance. And so this puts him at 835. So now he has 1.8. So now the question is, does he need 1.8, or would he be just fine with less than 1.8? That's a conversation for you and your client, but you've got to have that conversation. You can't just say, hey, yeah, that's it. That's the best. That's the best you can do. Yeah, 800,000 of life insurance. Why? Because that's being selfish. All right. It is max funded. Okay. So there's two things, not to get in the weeds or anything, but you have your MEC premium here, your target premium, okay, and your single guideline single premium. Okay, so to max fund this, the most you can put into this is $288,402 in like the first 5 years. Okay, if you put that in the first 5 years, then that's the most you could put in. Okay, the target premium, just rule of thumb here, that your target premium should normally not be less than your annual premium. So your annual premium's 18,000 because we're putting 1,500 a month. So just remember that if you have it structured to where your target premium, no, I'm sorry, forgive me, erase that. I was thinking it was the other way around.
I'll edit that out.
Yeah. Edit that out. Because I was, for some reason, I had 18 in my brain, thinking it was, if this was 18 and this was 14, then you have a problem. It's not really structured right. So your MEC premium here, this is the most that you can put in any 1 year. Now, most carriers, Mutual of Omaha, F&G, all the others that we use, normally you don't know this number here. They show you the target premium, they show you the guideline level, and the guideline single. That's usually what you're seeing, and that's the numbers that you get. Okay, I like the fact that National Life Group says, hey, this is the most you can put in, because maybe you have somebody who flips houses and they're like, hey, if I sell this house, can I throw an extra 100 grand in here? No, you cannot. The most you can put in is 57,333. Okay. So that's, that's you're limited to that, and you're limited to this, but that's if somebody's seriously overfunding it. But now let's just talk about simple, again, structuring your IUL. So we're going to kind of come back to this right here. What is the need of the client? Well, the client doesn't necessarily need 800,000 unless they want it. If they say, yes, I'd love this, this is great. Okay. Well, at age 68, he's got $733,000 in his cash value. Okay. 857,000 of life insurance. Man, if he's super happy with that and he loves the fact that he has this 835,000, then great. See if he can get approved. That's it. It's as simple as that in structuring an IUL. Okay. Now, if we go back here and we look at, we already did minimum death, max cash value. So that's already given us the most cash growth at option A, level. Okay. So another thing to remember, doesn't matter what carrier you're illustrating, change year on level always has to be M. All right. M stands for maturity. When this policy matures. This policy matures at age 120. So it's the end of the policy, basically. If you're going to do increasing, well, you don't want that increasing to continue, all right, until forever. Otherwise, I can show you when we do a distribution how it's going to eat away at the amount that the person's going to be able to pull out of the policy, because it's still increasing. It's still costing money for that more and more life insurance. And so we want to stop it. We want to level it. So we're going to do this, and there's a couple ways. Depends on the person's age, but normally what I like to do is let's go to the year that they're funding it to. So age 67. All right. So I'm funding it. If y'all see that right down here, from 1 through age 6, 7. Okay. So that's when he's the premium amount here. That's what you're that's what they're the premium. Okay. So we're going to stop it, change year at age 6, 7. All right. That will then level it off from 67 on. So if we come back now and look at where we are, well, that dropped them down to 492,000. That puts him really close to that 1.5 million that he should have, rule of thumb. Okay. It also probably is going to give him a little more cash growth. Okay. Because he was at 730 or something. He's about $50,000 more in cash growth. Okay. It was at 857. If you remember the over here, the life insurance was only 8. Now it's 1.1 million. So he's even has more life insurance for later on in life. Because why? We did increasing. Now we stopped the increasing at age 67. So if you look right here, it's 1 point, oops, yeah, from here to, it's from this point, right? All this is 1.75, okay? Let's see if I can do it like that. Oops. There we go. So all that's level, okay? The reason why it's increasing, if you look over on the right, this 1.222, okay, if you look here, it's growing. Why is it growing? Because your cash is growing. The cash is pushing up the death benefit. It has been the whole time. However, we leveled it off. And because we leveled it off, we did that through the increasing and then level. And then you just can't stop it from growing because interest rates are going to keep it growing. Okay. So,
Hey, Francis,
yes, sir.
I want to make a quick comment because we were talking about he may not want all that life insurance. So, just a quick comment, you've got to talk to the clients about, is that work insurance? Is that term insurance? Because what's going to happen typically when that term ends, when he's 70, 75, or 80, he's going to be uninsured. Where here, this is permanent. So if it's work insurance, when you usually leave work, that insurance doesn't leave with you, and so this would be permanent. And that usually, a lot of guys are like, huh, that makes sense. Yeah. Because at the end of the day, we want to show the value of these policies. And that's one of the huge value points, is that a lot of times work insurance is not permanent. When you leave, it doesn't leave with you. Number one. Number two, it's term insurance. It'll eventually term out, and you're going to be in your 70s shopping life insurance, and you're not going to have many options. So just to throw that in there.
Right. So yeah, the so this one, when we did increasing, it started it now instead of 895 or 875, whatever this was before, and stayed level. It's increasing every single year. It gets a little bit more, and what that does is that allows this person to still put 1,500 a month in it. He's just starting with lower face amounts, and then it's going to grow. Okay. When we do level, it, and I'm going to leave it at age 67 for right now, because then it's going to go back to increasing. So we don't want that to happen. So that's why level always has to be M. But it's 865 and it stays at 865. But when you look down here at age 67, there's 921,000. Okay, because it's starting to increase. Okay, instead of staying level. Because I didn't change that to M. If I change this, so whenever you're level, just remember, write this down, level M, levels into the policy year. It never changes. Once it's level, it stays level. You don't want to increase it later on. That's silly. And then increasing, you want to stop that increasing to stop that cost of insurance. So now when you look at it, it's still at 835 here. Okay. The only reason it starts growing after this is because the cash growth is now pushing it up. Okay. but it's still a lot less life insurance. It's at age 67 or age 68 as 857. Let's use age 68 here. The first year that he's no longer putting any money in. Okay. It's 857 of life insurance, 733 in cash, and that's starting it at 835 as level. Okay. So again, if we go increasing and we go to age 67, okay, then that's going to drop it to 492. It's going to increase every single year because it's increasing until age 67. Then at age 68, instead of 857,000, it's 1.1 million. So it actually increased, it grew the life insurance more, okay, because of the cash growth. Even though it was increasing, okay, it started off way lower, but we're also going to have more life insurance later on. So it also gives them, instead of 730, about, again, 50,000 more in cash over 24 years. So that's 2,000 a year. That's pretty good. Now to go the minimal, okay, the most that you can max fund a policy is by increasing 1 year past funding it. So that's age 68. So you have age 67. Now, again, this might not be enough life insurance for the guy, okay? Because now it drops him to 309. Now he had $1 million. He's got 1.3, okay? But he might say, hey, I'm paying my loan off real fast, and I'm putting a lot of extra money into my mortgage, so that mortgage is going to be down in a little bit, so I'm good with the 1.3. Okay, again, you want to make sure that the client is comfortable with the amount of life insurance, because it is going to go up. Okay, it is going up as we go, and it's not quite as much. It's more than if it was level at age 68. Okay, a little less than if we stopped it at the last year of funding. This, we increased it to 1 year after funding. Does everybody get that?
Yes.
And what that did was that reduced it to the lowest possible amount, year one face amount of life insurance that the person could get. Okay. So this is the most that you can quote max funded. Now, it's not really max funded, because when you do level, this guideline single is 107,000. Let's see. Let's just do, for shits and giggles, excuse my French. We're gonna do 18,000 times 23 years. Let's see what that. Oops, that's not what I wanted to do. Dang. Can y'all see my calculator? Can anybody see my calculator?
Yes, we can. Yes.
All right. So 18,000 times 23 years. So you and I were a little bit wrong, Neal. So he's going to put 414,000 into this policy, and he'll have 790,000 in cash growth and $1 million in life insurance. So life's pretty good, and then it's paid up. It's done, So he's more than doubled his money, or right at doubled his money. He will the next year, and he's got $1 million of life insurance and it's going to keep growing as well. So he'll leave a legacy. He'll be able to use money, etc. So
Francis,
I think this comes in the first 7 years, Neal, or the first 5 years is what this is. You can't overfund it early based on this guideline single, is what it is.
Right. So just to be clear with everybody, how do you properly structure an IUL? You ask your customer a lot of questions about their debt, what they're trying to accomplish, and then they either want death benefit or they want max cash accumulation. You you can't have max death benefit and max cash accumulation because the money, just visualize the two buckets. You have the death benefit bucket, you have the cash bucket. Whatever, the more life insurance you have, obviously, the more money goes into the death benefit bucket and the rest goes in the cash. So it's like whack-a-mole. If you take this one from 309 up to 850, more money's going to go towards that, less money's going to go in the cash accumulation bucket, and it's not going to accumulate as high. Francis, what we did, why don't you show them if someone says, "Hey, how do you max fund an IUL?" Didn't we put
So
21
yeah,
45?
that's so the way, to take that same 1,500 a month that he's wanting to put in, if you will, if we did this as level. So I'm going to show you back to level, and also what I like about, I'm also going to show you these here, the balanced based on target. So if we start at max cash level, what Neal and I were talking about is you can fund this policy, this 288,402, if you look right here under guideline single, over 5 years. So you can divide that out. I think it's 57,333, and it's going to be 5 years and some change. Okay, because this is the most you can put in any one year. All right. But also, what I want to show, just for properly structured IULs, you shouldn't have a zero beyond year one. Okay. The only time you're going to have a zero beyond year one is if you have a 10-year-old or 8-year-old or a 1-year-old. Okay. You can't even help it. They're putting $100 in a month, and it's going to have 2 or 3 zeros in there. And you've got the lowest amount of life insurance, and it's still going to be there. But for normal clients that are in their 20s, 30s, 40s, 50s, you should not have. And that's where some of these IULs, they call them IULs. Okay. I'm not going to mention any names. They'll have 4 zeros in here, 4 years of zeros, surrender value. Well, that stinks. The worst you should have is 0 in year one. And that's usually going to, when you're level. Okay.
Right.
So this thing,
when you have 4 zeros, that guy structured that policy to give him maximum commission at the expense of the client.
right.
That's
So what
how.
it is this same amount here can give you $1 million of life insurance. I could say, oh, you want to do 1,500? Oh, no problem. Oh, you want $1 million? Wouldn't it be great to have $1 million in life insurance? Oh, yeah, $1 million would be great. Everybody wants $1 million in life insurance. Okay, let's do $1 million in life insurance. Oh, I didn't even move it. Okay, let's do
go
1.2.
Go to 1.5.
Yeah, let's go 1.5 million. Sure. There we go. We got 2 zeros. Okay. And what does that do for him? Well, he's got 1.5, down here, but he's got $200,000 less of cash growth than if he would have just run it as level, as max, min, max. So normally when somebody wants an IUL, they're interested in some cash growth. So don't, and then if you look right here, now, okay, so here's what I was trying to say, and my mind played tricks on me. It was 14,000. If y'all remember when Neal said, "Oh, I'm going to erase that," for some reason I was thinking the 18 was up here and the 14 was here. But see how this is 25? You should never have a higher target premium than your annual premium. You should never have a higher target premium than your annual premium. Just remember that. Okay. Otherwise, it's definitely not structured right. Now, if the guy wants 1.5 million, okay, there's a better way to do it. I'd do about $500,000 maybe, or something as permanent, and $1 million or $500,000 as term. It depends on why he wants that and how long he wants that. You should stack the two. You should stack a term policy with an IUL. I mean, that is really the proper way to do it. However, this is how you should not do it, and it shouldn't be 2 zeros. So just to let everybody know that. Also, everything's gone up. the guideline singles now. Why? Because everything's based on the life insurance. Okay. The more life insurance, the more money you make. But just to let everybody know, you don't make $25,215 on this policy. You're going to make the lesser of the annual premium and the target premium. So whichever one is less is what you're going to make money on. That's what you're paid on. Okay. That's your commissions is based on whatever's less. Okay. So I hope everybody knows that. If not, I'm informing you right now. So if we go back to where it should normally be, like let's say minimum. Now let's say the minimum, he really wants a little more than 800,000. Okay. Because this is our level, 835 is your face amount. Well, each, again, Mutual of Omaha, F&G, they all have little buttons. You could go to that next one, okay? This one's balanced death benefit. It's going to give a little bit more cash, a little less cash, a little more life insurance, and even everything out a little bit than the min max, okay? So now we're up to $1 million, okay? However, there's still just 1 0 there, which is good. Your target premium is less than your annual premium, but boy, it's really close. Okay. Normally our target premium somewhere, a third to a half of what your annual premium is when it's normally structured right, unless they just want a lot of life insurance. Okay. So this right here is balanced. If we go to the next one, it's going to be based on target, meaning it's going to be dead on 18. Okay. Why? Because target premium is 18,000. 18,000. That's your target. All right. So it created the amount of life insurance that matches this target premium amount, which also matches the annual premium. So that's as far as you go. Now, I've never used this protection focus because it messes with things down here on this retirement and protection stuff. So
yeah, it activates the additional insurance rider.
Okay. So if you hit that, let's see what it does. Wow. Oh, it did the additional. So protection focus, interesting. I did not. Now we're getting
That splits it 2/3 life insurance, 1/3 additional insurance coverage.
Okay, so up here, this initial face amount 650, but it adds an additional to equal $1 million death benefit. Okay, so that's the protection focus. I can't say I've ever really used that.
Either.
And it also dropped the premium amount, which is weird because we were at one point we were at $1,500 a month. That should still be 18,000. So yeah, I don't use that one. It doesn't make sense. But you got to remember, look, to go back and make it none when you go off of that. So when you go back to min max, you got to take this protection focus off because it grayed everything out. So just go to none. And then we have to go back to our $1,500 a month and everything else is good. So we're back to where we are.
So Francis, we're getting some great comments, right? People are asking questions as we go.
I think it's time to start asking, open up for questions.
Well, let's do this. Let's just, because they're writing them in the chat. So the first thing is, let's show them the lifetime income rider.
Okay.
Because they're asking, do you get the cash accumulation paid out to you? Do you get the death benefit? So let's show them how that works.
So just to let everybody know, the money you get to work, when I'm sharing this with somebody, I tell everybody the surrender value is your bank. This is the column that they get to use that money. Okay. So that money is down here that they get to use, $1 million, one of those, Now, the accumulation value or the premium is what adds to that surrender value. Think of the accumulation value as a tally. The accumulation value never goes down. It doesn't matter if the stock market crashed. It doesn't matter if you're pulling money out of the policy. This accumulation value only goes up. And you're going to see when I start doing the income rider, okay? When we activate the income at age 68, you're going to see this is going to continue going up. Okay. Might not go up with the same speed and velocity as it is right now without any money coming out of it. okay, because you're at 21 million by the time you get to 120 years old that this policy will accumulate. So that will go down a little bit, but it never goes down. And so I'll show you that. So those are two things I wanted to emphasize. Now, the way you do it here, all carriers, you guys need to go and practice with your different carriers, but they all have some kind of a distribution or withdrawal, that you can click on and you can select when and how much. So I like to use the solve for income. This does activate a rider, but it doesn't activate until they start pulling the money out. Okay. And it is, once they start pulling the money out, it is guaranteed, just to let everybody know that. This one here is a lifetime income benefit rider that is a paid rider that starts from and has to be started day one when you actually write the policy. Okay. But you're going to see that it changes it to standard loan. So I'll show you, this is a lifetime income rider. All right.
Oh, it's monthly. You got to change it to annual.
And it doesn't matter. Monthly's fine. It's only going to show us an annual. Okay. But it's going to pay out monthly. Okay. So $48,951 the rest of their life is what they're going to get paid. All right. On that. As you can see, 728, this is still growing. It's never going to go down. It only goes up. Now, it only goes at 15 million because we've taken however much money out of it. So it slowed the growth. It didn't grow to 21 million, didn't accumulate to 21 million, only accumulated to 48 some million because this cost of the loan is reducing how much keeps accumulating. So just think of the accumulation as more of a tally. So that's your 48,951. Now, if we go back, I like using the solve for income because it is a paid rider. It just doesn't start until they actually start taking money out of it. You got to make sure that you go to a participating loan, okay? Because a participating loan allows the accumulation value to continue growing, and that's what you generate interest on. And you're going to see it's going to also allow them to probably pay out more money. So instead of 48, it's paying out 61. Okay, it's not a paid rider. It didn't take away from the accumulation value like the paid rider did, because the paid rider costs. So if it costs, it's going to accumulate less because there's a cost. So again, accumulation value never goes down. Look, you're still taking money out. It's still going up. Now it accumulated still 21 million, even though we took all this money out. Okay. So it's just how the money is, now again, your surrender value goes down and your death benefit goes down because your surrender value reduces your death benefit. So also, to answer a question a lot of people have is do you get the death benefit and the accumulation value and the surrender value? Wow, 600 plus 800, wow, that's 100, that's 1.4 million, No, this is the net death benefit. The surrender value is already calculated into the death benefit. So if you take out 100,000 right here, this is going to reduce this 835 down to 735. It's going to reduce that death benefit. So your surrender value is.
Oh, sorry.
No, go ahead.
How many years do you have the 61,666 paying out?
From age 68 to 120.
Okay, well, let's say they live 20 years. So 61,666. Let me just do this, 61 times 20 years. So they're paying in 414,000 and then they're taking out 1.2 million. And that is the power of an IUL right there.
Well, and if they're 20 years, so say 44, and they're still leaving 356,000 behind. So it's more than that. Paid out 1.2 plus their family gets 360, so it's 1.5, 1.6.
So whatever they don't pull out, so the way the insurance company does it, they actually loan you the money, which is why it doesn't come out of your accumulation value. but they collateralize it through the death benefit by reducing the death benefit. So if you live to 120, there's no death benefit, but you've taken out 3 times more than you ever paid in. But in this case, if you passed away at 85, you would get 61 grand every year plus 416,000 to your beneficiaries. And that's what fires people up about IULs.
Yeah. So this is the solve for income. Again, they all have some type of an income where you can show that in the illustration if somebody wants to see what this would do for their retirement. Let's see. Any other questions?
There's a question on here about the policy fees by Jeff Morris. You can actually we won't get into
So
that.
what I like to tell everybody is look at the surrender value. It's 0. Your accumulation value is 13,000. Okay. The reason why there's a surrender charge for the first 10 years, okay, if you come across here, you see there's a difference, 170, 167, 818. The next year, these two are identical, okay? That's year 11. So the first 10 years, almost in every policy, now some carriers are 15 years. So they have a surrender charge for 15 years. That means they're still taking money out of there's still a cost in the policy. So all IULs, doesn't matter what the carrier is, year 1 is going to have the most amount of money come out. Do y'all know why? Because you get paid. The next is year 2, then year 3, and you can see it's only 70 to, it's like $3,000 here or something, where it's 13,000 right here. There's a difference of 13,000 here, and it's 3,000 at year 10, and it's 0. So after year 10, for the most part, there's not hardly any cost. Okay, and the way I like to show people is, do we have time? Anybody familiar with the rule of 72? Anyone?
Yeah, I've heard of it.
What's the rule of 72?
Rule of 72 is whatever your percentage rate of return is. Let's say it's 10%. Divide that into 72, and it'll take you 7.2 years to double your money.
To double your money. Okay, so this is a 6. This is we're going to use 72 divided by 6.45 because that's what this is illustrated on. Okay, so in 11.16 years we should double. All right, so let's take a round number, as round as we can get, 1 million. Okay, so that's going to be 2,020,000 in 11 point something years. So here's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. This is the 11th year. Okay, there's no cost when it gets into the accumulation is so big, it's covering that life insurance. So the only reason I'm coming this far down to do it is I can't show the rule of 72 when there's money going into it. There's too many calculations. But I could do it from here too. 733 times, doubling your money is 1.4, right? So we can go 1 year, 2 years, 3 years, 4 years, 5 years, 6, 7, 8, 9, 10, 11, 1.495. All right. And that's right at the 6.45% or better. Okay. So there's no real cost later on. After 10 years, the costs keep going down every single year. So hopefully that answers that. Any other questions?
Hey, Francis, so let's just, we got a couple more really good questions, but just so we don't run out of time, simplify it down to its basic. If someone's going to write a policy and everybody's new here and we've just showed them a lot of stuff and probably a lot of them are overwhelmed, but just show them how simple it is to do an illustration and write a policy.
So minimum death, maximum cash value. If they're in their 50s or 40s or 50s, I'm going to definitely leave it level. 30s, it depends on how much life insurance they have. 20s, I'm going to increase, and below, they're going to be increasing. Okay, because nobody normally in their 20s needs $800,000 of life insurance or whatever, and so they're wanting something to put money aside. So I'm going to definitely do increasing, and in my change year. Okay, so that's it. So normally, so the easiest thing is you're just going to do. It's going to be on none. Okay, and this is National Life Group, but this is anyone. You're going to pick a min max selection. Okay, you're going to do level. You're going to ask them how they want, monthly or annually. 99.9% of the people do monthly. And then you figure out amount. Yeah, I want to do $300 a month. Okay. And then you come over here and you view it. And then you go through it with them. That's going to give you $162,000 of life insurance. Are you good with that? Yeah, I'm good with that. I don't have a mortgage. I just have my car, not married or whatever. And it's going to give them $139,000 if they never increase it, when they go to retire and they've got this life insurance. So that's it. It's as simple as that.
And then you just you save it. You save the illustration with their actual
up here. You do a save as. I don't know if you saw where I clicked that, y'all, but it's up here in this blue save as. Put their name. And then I have a folder that all my illustrations are in. Guess what it's called? It's called illustrations. And I have 1,385 illustrations in my phone. So wish I would have sold 1,385 of them.
Right. And then that little button turns green, and that's where you click on and you go right into the app, and it takes the illustration, matches it into the app, and you write the policy. It is really that simple.
And that's why we like National Life Group. I know, a lot of people like F&G, and there's others, and there's some that, are simple or whatever, but this one is pretty simple. If this green doesn't show up, that's because your client information, there's some issue with your client information. If you see these little yellow things, that's why this e-app's not showing up. So anything else?
One of the questions was, how do you do a policy to kick out a certain amount of income? Let's say somebody is 45 and they want to have 100,000 a year, like a pension gap. They want to have an extra 100,000.
Well, they're not gonna. That's not normally a pension gap. Extra 100,000 a year. Pension gap's going to be like 10,000 a year, or 20,000, or 40,000. You're getting a little crazy.
But
truthfully, I've never done it that way. Again, you're going to do it through this, death benefit and fund. I mean, this solve for income here. Okay. And then all you're going to have to do is you're going to have to just sort of play with it. Okay. You got to get it to the lowest amount, meaning you would have to make this level increasing in 1 year past funding it. Okay. So age 68. And then you would have to figure out, it was 60,000 at 1,500. Let's try 2,000. We're going to go to, this is a 45-year-old, and that puts them at 94. That's pretty close.
So you just play with it.
You just have to play with it. Either way, in anything, play with it as far as life insurance. Play with it as far as
once you guys get contracted, you want to write an illustration on everybody in your house. Write it on your dog. Write it on your horses. Practice, and then you get so comfortable with it, you go, man, this is pretty simple. And it takes the hesitation away.
Yeah, here's what's crazy. Let's say you run across a grandfather, and they want their 1-year-old grandchild. Okay, and they want to insure them and put $100 a month on them. And you're obviously going to do increasing. If I'm keeping it at age 67, so this is going to go to age 68. And, it's 50,000 is a minimum of the life insurance. So it did go to 65. And the crazy thing is it didn't have a bunch of zeros, because sometimes I've seen it where there's still zeros here. That's usually if they're putting way more money in, is what it is, I think. So $100 is not bad, but that kid's could have if they just put $100 a month, and that's it. and never changed it, they're going to have $100,000 of income for the rest of their life in retirement. Just it's amazing. Every grandparent should be spending $100 on their grandchild a month, and then hopefully they're teaching their grandchildren when they're 22, 3, 4, 5, how important this policy is to keep it going. Because they could turn this into 250,000 and retire when they're 55 if they wanted to, just by throwing extra money in later on in life. You can set these up to be college funds where they put a bunch of money in early, and then when they're 17, 18, they have 200,000 right here, not 30,000. This is only $100 a month for a 1-year-old. It is so awesome of a policy. We just have to get it out to the right people and structure it properly for them.
So put a 1 in the chat if you felt like this was helpful tonight. Also put a 1 in the chat if you'd like to get a copy of this, because you're going to automatically get a copy. I record it tonight. I edit it, send it to Leanne. She sends it out to everybody first thing in the morning. So you guys will all get this. And this is what we do every Thursday night. Mondays, if you want to build an agency, at 12 o'clock Eastern, we have an event where everybody from corporate FFL ties in, and they bring one person on to teach about how to grow an agency. On Thursdays at 12 o'clock, we do we hesitate. We do an IUL week 1, an annuity week 2, and Q&A week 3. That's corporate wide. And then Thursday nights, we do this where we probably next week we'll have Felipe, and we'll have Taylor, and we'll have Danny, and we'll have Preston, and we'll do kind of interaction so you can hear from some new agents and how they got over their fear of getting started. Which how do you get a quick start? You start. So that's how you get a quick start. How do you get off to a fast start? You just start. That's how you get off to a fast start. And let's see, what was the other? One last thing we want to touch on. This increasing doesn't automatically turn off. If you have an increasing policy, that client's got to know that at a certain age, they're going to have to go ahead and call the company and stop the increasing. I used to think that was an automated program, but it isn't. So just so you know. Anyways, and the other thing, when you do increasing, it does dramatically reduce the amount of commission you get. That target premium is what you get paid. But in the case of writing kids policies, you make a couple $100. It's not a lot of money, but that kid sure is going to be happy if they get to age 67 and never touch it, right, Francis? And then I saw another question for you, Francis, and maybe we'll end on this. How the heck did you write $1 million in IULs last year?
I stayed consistent, and I did over 400 some thousand, and then I had a big case that closed.
There you go. That's how you do it.
That pushed me over the $1 million.
Did you buy any leads?
I spent $90,000 in leads last year.
And you did $1 million.
Yeah.
Yeah, and I think I spent 52,000 last year and did 200 and some thousand.
I mean, it's a marketing budget.
It's a marketing budget.
If you look at, look at it as business. It's a business expense.
Yeah, yeah. So guys, thanks for jumping in. Record numbers tonight, 49 people, which is great. Invite your friends. We cover good stuff like this every week. Get a lead strategy, get some kind of strategy, because it's just really the key to moving your business forward is having a consistent lead flow of people that you can call. Because otherwise, it's like a network marketing company. You're chasing your friends and family, and after a while, they'll quit talking to you. And no one wants that. Because 4th of July holidays coming up, who wants to sit around by themselves because you've chased them all off because you're trying to sell them life insurance? So anyways, so thanks for jumping on, everybody. Have a great weekend. And if you need anything, don't forget to get on the Slack channel and post any policies that you write. and we'll see you next week, same time.